This is Professor Hazara, and this is sort of the continuation of the Pfizer valuation, and you will sort of view this as a model for Lilly. Okay, and in the last video, what we did was, what I did it for Pfizer, and in the assignment you did it for Lilly, is for Pfizer anyway, and then you compared it to Lilly in the assignment. Went to the analyst estimates, and for fiscal year 2021, that was looking forward, the estimates were $3.39. The estimates are generally trending upward. The 5-year growth rate, I think it was out from 2019 or from 2020, but we'll use was about 3.7%, which is not a lot. Now, Pfizer is going to give you 3 to 4% growth in the stock plus a 3 to 4% dividend, so that's like a 7 to 8% return, which isn't bad. Okay, and the 1-year growth rate was 16.5, which probably has to do with the vaccine. So they're expecting a bump up with the vaccine, and then probably lesser vaccine sales in years after that. Okay, and then the free cash flow, you started with net income of 16,302. Then we took the adjustment for working capital, which is from the statement of cash flows. Add back depreciation, which, as you can see, is also from the statement of cash flows. Then take out the capital expenditures. Then we got free cash flow. And this is the cash. This is very basic calculation, by the way. Available to pay interest and dividends. Okay. Anyway, so we're going to use this information here to do what I call a short form valuation. And what we're trying to do in this valuation, and this is very rough, believe me, this is very rough, but in the final you're going to have to do a full valuation. So we're leading up to the final exam. This is a quick back of the envelope, sort of rough estimate of the stock price. And we know that Pfizer's been trading between the $33 and $40 range for a few years now. So, and then we'll probably overshoot it now because we'll probably overshoot it because we're not taking out debt. Basically, we'd have to make some more advanced adjustments. But this is I'm just showing you how to do this. And finally, you're going to have to actually do it. Okay, now I've come over here to let's call this a template. And I'll put this up so you can use the same template when you're doing Lilly. So, we're going to use what is called a two-stage valuation model. And what we're doing, when I say valuation, we're trying to estimate the stock price. So we're going to use this rather simple model. We're going to get an estimate of the stock price. If the actual stock price were below it, theoretically, you should buy the stock because our model says if you believe your model, the model saying it should go up. If the model target price is higher than the stock price, the actual stock price, buy the stock. If the model is lower than the actual stock price, you sell the stock. That's the idea. Okay, and we're going to use what is called two-stage valuation. This is a common type of valuation, and this is a little bit for Pfizer. This is a little bit it's a misspecified model because back in the day when Pfizer was selling Viagra and Lipitor, it was growing at 12, 13, really a super growth rate, a good rate, which is basically over 10%, or even 8%. But now it's growing, as you can see, if Pfizer's growing, I think they're saying 3.7%. The expected growth rate is 3.7% over the next 5 years. So, this model will give us will be unrealistic. I'll use 3.7%. That's not really a super growth rate. A super growth rate would be 10%. I'm just using Pfizer for two reasons. Number one, it's a drug company, so its financial statements are like those of Lilly, so you won't have a lot of questions. The format is very similar, and also because it's a major company. I'm starting to look at it, but basically, I want to take a pharmaceutical company and do valuation of another pharmaceutical company, because if I did another industry, then you might get confused. Okay, so let's. So what we're going to have here is we're going to pretend that for 5 years, Pfizer and maybe the vaccine will cause the sales to go way up. Maybe they're underestimating them. So we're going to assume that for Pfizer is going to grow at some high rate, and we're making a big assumption here. This could be like it's not going to 3.7% is not a high rate, but we'll just assume it is. I'm just teaching the mechanics here. So for 5 years. So we're going to assume that it grows at for the next 5 years at a high rate, and we'll call it the super growth period. And these are terms that are usually used. And then we're going to assume that at the end of the 5th year, that its products mature, its drug pipeline gets old, and so the company's growth slows. And at the end of the 5th year, from the end of the 5th year to forever, because we have to kind of estimate, we assume the company is going to live forever. That's what we assume in accounting and finance. We're going to have to kind of find a way to value what we call the terminal period. And the terminal period is the period that ends at year 5. No, that begins at year 5 after the super growth period and then goes on forever. We're going to assume that after year 5, the company grows at what we call a constant growth rate. The constant growth rate, by definition, is the company will grow, here it is right here, at the rate of the economy, 1%, let's say. Let's say the economy grows at 1%, which has probably been the average, 1 or 2% for a few years now. Okay, so we're assuming that after year 5, the company's products mature, and it grows at the rate of the economy. So we assume high growth for 5 years and constant growth, which is the rate of the economy for year beginning at the end of year 5 and beyond. So here's what we got. Let's do some inputs here. We're going to take the super growth rate, and this is really we're going to assume 3.7%, and we're taking that from the analyst estimates. Now, I think Lilly actually has a great advantage in growth. That's why I asked the question, I think. But so Lilly, Pfizer is expected to grow 3.7. Lilly is expected to grow at a higher rate, which might actually be closer to what we would call super growth rate. Okay, the super growth cost of capital. Now, the markets actually charge an interest rate on stocks. And that's usually done by something called a capital asset pricing model. I'm not going to get into it. But usually, let's say that it's 6%. It's probably a little bit higher than that. But you can use these same numbers for the cost of capital. You can use the same numbers for Lilly. But I'm putting it here. Okay, and then, so we're assuming that Pfizer is going to grow at 3%, near 4%, and we're assuming that's a super growth rate, which it's not, but I'm just showing you. I wanted to use a company in the pharmaceutical industry, and that the super growth cost of capital is 6%. So we're going to discount those cash flows by 6%. Okay, then we go into the constant growth rate. So this period starts in year 5. This period starts in year 5 and goes on forever. Hope that's how you spell forever. Okay, anyway, and you may be asking yourself, how do you value a cash flow that goes on forever? Well, actually, it's quite easy, and we're going to be using a formula. It's called the constant Gordon growth formula, and really, I don't want to get into it's a finance topic, really, but there are formulas which finance people have developed, and the calculus really isn't all that hard, which actually take a cash flow, it could be a dividend, interest, whatever, and value the cash flow that starts at some date and then goes on forever. Your formulas are actually very simple. There's two basic ones. One is called the no growth, and the other one's called constant growth. We're going to be using constant growth formula. We'll get there in a second. But here's what we're going to have. We're assuming that starting in year 5, the company will grow at the rate of the economy, that the company's growth slows down. So let's assume that's 1%. And you can make these assumptions for Lilly to accept the super growth. That should come from the analyst estimates. Okay, let's assume that the cost of capital, it should be lower than the super growth cost of capital, because if you have slower growth, that means you have less risk, more likely, and less risk than the return the market demands is lower. Okay, so let's assume this is 4%. There's a reason I'm putting 3 percentage points between those. Okay, so we've got those, and notice you can assume these three numbers, assume the same ones for Lilly. Okay, but take this number from Lilly's estimated growth rate from the analyst estimates, and I believe they grow much faster than Pfizer. Okay, Pfizer used to grow back just about 10 years ago when they were doing Lipitor and Viagra. They used to grow at a lot faster pace than they are now. Okay, that's the first calculation. Those are sort of the inputs there. Step 2 is calculate free cash flow. Well, you've already done that. We've already done that, and so I'm just going to copy these numbers from the free cash flow calculation, really from the last assignment. So, this is a step type series of assignments. I'm just going to go ahead and calculate those from the last assignment here. Okay, and it's the same free cash flow you had. So we're saying that Pfizer has free cash flow in, I think it was 2019, whatever it was, of 16,105. Okay, so what we're going to do is the super growth period. We're assuming that the cash flows are going to grow. Let's bring the growth rate down here. I'll go ahead and bring this growth rate down here. The cash flows are going to grow at 3.7%, and we're assuming that the discount factor is 6%. So those are the kind of the two numbers that are going to be important here. Okay, so what I'm going to do is we're going to start with this free cash flow, and I don't think that's the date. I think I was going to put in, I think we were looking at 2019 here, whatever date it is. I'll let you fiddle around with that, but whatever date the statement's for. When you look at some of these statements, I forget which date it is, and they keep coming out with statements. Anyway, so whatever year we're working with, start with 16105. Okay, and what we're going to do is that this number here is going to grow for the next 5 years during the super growth rate period at 3.7%. Okay, and that's, like I said, that's really not much of a super growth. I'm just showing you the mechanics, and this really model is probably more appropriate for Lilly because it really will be growing. It grows a lot. It's supposed to grow a lot faster than Pfizer, I think. So what we're going to do is we're going to take the initial, this number here, 16,105, and we're going to multiply times 1 plus our super growth rate. Okay, which is 16,701. And we're going to grow the cash flow on a linear basis by 3.7% for the next 4 years after that. Okay, and so what I'm going to do is, just so we can copy it down, is you got to freeze the growth rate, and then we'll just copy this down. And you'll see it really is pretty slow growth. Okay, so there it is right there. So each of these numbers, it should be growing at 3.7%. Okay, now the discount factor. This is why I had you do bonds. This is why you got to do bonds before doing this. Remember, in bonds, what we did was we discounted cash flows that we were interest payments that we're going to receive in the future. We discounted them back and came up with bond price. This is almost exactly the same. We're going to discount these cash flows by 6% over a period of 5 years. So what we're going to do is we're going to use the same formula that we used for bonds. We're going to discount by taking 1 over 1 plus the super growth period cost of capital, and we're going to raise it in the first period. We're going to discount it back by 1 year, so we raise it to 1 year. Okay, which is going to give us a discounted cash flow of 15,755. Now, what we want to do here is we want to do two things. We want to, in the formula, we want to freeze. We're going to go ahead and just do this. We want to freeze the 6% for each one of these years, coming down, because we'll discount it by the same rate. But we're going to be raising it to greater powers, because in the next year, we're going to discount it back by 2 years, then 3 years, and 4 years, and 5 years. So we've got to find a way, number one, to freeze the 6%. And we do that by putting dollar signs in there, right there. And you'll notice that what I've got is in order to raise in Excel, in order to raise a number to a power, you just put a caret there, and you refer to the to the particular cell. And what we've got there is, once again, we've frozen the 6%, and we've raised that to 1 year. So we raise it to 1 year. Now you can just copy down, because the only number that's going to change is the year, the number of years that you're going to discount by. And so notice, I want you to notice something, that this year it's still 6%, but you're discounting back by 2 years, which it's raised to the 2. This year, still 6%, but you've raised it to the 3 years, and so on and so forth. And finally, that one's for 4 years. And then this one here, the final one, is for, you raised it to 5 years. So the 6% stays constant, but you're raising it. Okay, and so notice also the discount factors go down, and that's all. It's always true in finance that a dollar received today, or in the near term, is worth much more than a dollar you receive out in the future. That's why companies like to collect cash now, because it's worth more. And we're not even talking about inflation. Inflation can be part of that equation, but no. Okay, so this right here, this is the value of the terminal period. So this is, we'll calculate, this is this is phase one. Let's call this, it's a two-stage. This is stage one. This is stage one. Okay, so I'm going to put in here, this is stage one. So we have a two-stage model, and we've already calculated the value of stage one, which is the super growth period. And we're saying, I guess this is in millions. Okay, the value of stage one, the value of the 5-year super growth period is, I'm going to put this in red because this is one of the numbers we're going to add. 5-year super growth period is 75 billion, maybe, because that's in millions, so that would be 75 billion. Yes. Okay, now we got to ask ourselves how we're going to, for a company, companies are assumed to live forever. They're going concerns unless you assume differently. And Pfizer's not going to disappear anytime soon. So we've got to find a way to take the cash flows from year 6, starting in year 6, and they go on forever. We've got to find a way to discount those. Okay, and there is a way. Okay, and we're assuming, if you recall, that the assumption in this model is that in year 6, beginning in year 6, the company is going to starts in year 5 at the end of year 5, beginning of year 6, and goes on forever. The company's growth rate slows down to 1%, and the cost of capital is going to go down to 4%. You can use those same numbers for Lilly. Okay, so here's what we got to do. We're going to use what is called, this is the equation right here, the Gordon growth formula, Gordon constant growth formula, and this here, if you just use this, and believe me, it works, is this will give you the present value of a series of cash flows that goes on that goes on forever and that grows at a constant rate forever. So you could say we're assuming that starting in year 5, Pfizer's cash flows are going to grow at 1% forever, and we're going to discount them back by 3%. And the formula to calculate the present value of those is very easy. We've got a numerator here, which is that number right here. And we've got this denominator, which is, you can see it right there, which is that right there. But all the numerator is, all we're going to do is take the year 5 cash flow. This is just the way the math works out. We're going to take that year 5 cash flow, and we're going to take it, we're going to update it to the year 6 value. Okay, so the way this formula works is, this formula is going to give us the present value of cash flows at year 5, of the Pfizer's cash flows that start at the end of year 5 and go on forever and grow at 1%. That's basically what it's going to give us. Okay, so the numerator is very easy. It says, and the numerator, in order to get the present value of cash flows that start at the end of year 5, the way the math works, that's all I can tell you. The way the math works, the calculus works, is that the numerator has to have the year 6, has to have the year 5 plus 1 year cash flow in there. Okay, so that's the number's not hard to calculate. If we're assuming that that Pfizer's going to grow at 1% starting at the end of year 5, all we've got to do is take the year 5 cash flow and multiply it times 1 plus, put a parenthesis there, 1 plus the constant growth rate, which is 1%. So we got that right there. So our year 6 cash flow, that's the numerator. It's simply, to get the present value at year 5, because of the way the math works out, the numerator has to have the year 6 cash flow in there. Don't ask me why. Well, I do know why. It's just the math, where the math works out. So that's pretty easy. And the denominator is very easy. All the denominators is the constant growth cost of capital minus the constant growth rate. And we know that the constant growth cost of capital, here's your constant growth cost of capital is 4%. And then we also know that the constant growth cost of capital, the cost of growth rate is 1%. So that's going to give us 3%. That's going to give us 3%. So that's what we're going to have. So anyway, so I should have done this. The constant growth cost of capital is 3% minus, I pointed at the wrong cell, minus the constant growth rate of 1%. So our denominator is 3%. So if we take the numerator of that ratio, which is the 6 cash flow for year 6, divided by, and we'll divide that by 3%, which is the constant growth cost of capital less the constant growth rate, this is going to give us 650 billion, basically. Now, this is the cash flow from year 6. This is the present value. I'm going to put this is present value of cash flows from year 6 forward, but discounted to year, but at year 5, and we must discount to year 0. Here's the only issue left now is we've got the value of our cash flows that start at the end of year 5 on to forever. But since we used the year, basically we based it all on the year 5 cash flow, and then we updated it to year 6. Since we did that, this is giving us the value of the present value of the cash flows from year 5 on to forever. It's giving us the value of the cash flows at year 5. So we've got this number here, but that's their value starting at year 5 on to forever. So we've got to actually discount those back to the present. And the way to do that is just to take the year 5 discount factor and multiply this number, the year 5 value, and discount it back 5 years, and that will give you, and I'll take that out for a second, that will give you the present value of the year, the value now at time period 0 of the cash flows that start at year 5, grow at 1%, start at year 5 to forever. Okay, so anyway, so I just bring this over here. Okay, and so what we've got here is we've got this is the present value of the terminal period, and then we've also got the present value of the 5-year growth period. So I'm going to put in here, I'm going to write in here, this is stage 1, and we come down here, and this is really stage 2. Okay, and so we're going to sum the 2 stages, and that will give us the present value of the firm. And it's really, and that's accurate, it's not really giving us the present value of the stock, it's giving us the present value of the firm, because the free cash flows, remember I said that they're the cash flow available to pay interest and dividends, it's giving us the present value of the assets, really. We haven't taken out the debt, and we won't. That's a very special adjustment. This is giving you at least an idea of how to do this. Okay, so the present value of the firm, of the assets, when I say the firm, I mean assets, is 651,308. Okay, now so we'll just take the present value of the firm. I'll just bring that down there. And then I'm just going to divide by the number of shares, and that'll at least give us some idea of what the share price should be. Okay, the number of shares is, you just go over here to the income statement and pick out the number of shares that we use for basic earnings per share, which is 5,569. Weighted average shares basic, that's the number you want. Bring those over here, and we get a stock value of about $100 here. And so that more or less is the stock price we get. Now, it's overvalued because we haven't really taken out the value of the debt. This is the value of their assets. If we took out the total value of their debt, you would get a lower stock price, maybe at $6, which would still be overvalued. But this is just a rough estimate. People are saying buy the stock, so maybe the one thing that may be hidden in that stock price is that what you're reading on the street is that Pfizer's own revenue forecasts do not include the expected sales of the vaccine. So maybe the street is expecting it, but I don't know. That's why, But anyway, so that's the general idea of how to guess at a stock price. If you believed in this model, which I don't really, but if you believed in this model here, Pfizer's trading at about 40 to 30, in the 30s, between 30 and 40. So any way you cut it, this model would be telling you buy the stock. Okay, now I'm going to put this up, and in the next video, you will see we'll start the final exam. But this is actually part of the final exam, so you didn't lose anything. Thank you.